through kind of the crop section first, and then I'll turn it over to Andrew to do the livestock. But I'm going to talk real quick. I'm going to give a quick supply and demand and price update. I'm not going to spend a ton of time on those topics. What I really want to spend some time on is some crop insurance. It's that time of season where we're approaching the sales closing dates. Hopefully people have already evaluated some of their alternatives for the upcoming year. I just want to kind of go through the basics of crop insurance, talk about why it's important to Tennessee, and then also kind of give a bit of a framework as to why it's important to consider crop insurance as a starting point in your marketing plan, because we really want to be aware that crop insurance is a very valuable tool, but is definitely not sufficient to provide the necessary price or revenue protection that most producers are going to be looking for. So I want to talk real quick about supply and demand. The USDA came out with their projections for the 2018 crop year. This is for corn. Where they've got it estimated right now is planted acreage at around 90 million acres. That's down just a little bit from 2017. Harvested acreage is is the same at 82.7. Yield down a little bit. Again, what they're using there is a trend line national yield at this point in the season. There will be adjustments to that yield based on some of their weather forecasts as we move through the growing season. So what I've highlighted on here is just a couple of quick things I want to touch on. Use a very simple color coding here. If it's green, it's typically going to be beneficial for prices. If it's red, it's probably going to end up pulling prices down a little bit. Obviously, there's been a lot of talk about beginning stocks. We have over 2.3 billion bushels available for the start of the upcoming marketing year. That's obviously going to mute some of the potential for price if we do get a reasonably good crop. In terms of production, where it's estimated right now is down about 200 million bushels from last year, which is a positive considering that we are looking at use being right around the same amount. Ethanol production is another one that's kind of a bit of a wild card. There's obviously some issues with the blend wall in terms of being able to blend a huge amount more of ethanol. However, there is some potential for export markets and having the E15 blend available year-round. Right now, USDA has ethanol use for corn estimated up 125 million bushels, which is an important consideration. You look at exports. Exports there's a lot of unknown surrounding exports right now, both for corn and particularly for soybeans. Right now, the USDA has exports estimated down from the previous year, down about 150 million bushels. One of the ones that's really going to dictate where that export number ends up finishing out for 2017 and moving into 2018 is where this second crop corn in Brazil will how much will be planted and what their yield will end up looking at. If we look at what the bottom line says for the upcoming market year, so this would be the 2018 crop, stocks down a little bit, but again, that's going to be tremendously influenced by where our production is in the U.S. I briefly mentioned Brazil corn acres. I just kind of want to highlight this because this is a really important change that's ended up occurring over the last 10 years. Brazil used to end up planting their first crop corn was their big corn production back in the 80s and 90s and right up into the mid 2000s. And what they ended up doing is they've switched now so that most of their corn acreage is actually coming out of their second crop. So it's obviously reversed the time period in South America. If you think about it, their first crop would typically be planted in our fall and then harvested in February through April, whereas the second crop would be planted right around this time of year, maybe a little bit earlier, and then harvested in June and August. The reason why I highlight this is it really does change kind of the marketing or the global flow of exports. Because if you think about when these supplies become available, if we're looking at a harvest that ends around April, there can be some delays due to logistics issues down in South America, but you're looking at those come at a time when our reserves are definitely trending down to the lower end. Whereas if you're looking at August and having the product end up, or the corn end up hitting the market in August and September, you're hitting kind of where we're beginning our harvest. You're getting a consolidation of of available supplies. And I think that's important. It could provide some additional opportunities at this time of the year for price rallies, and we've actually seen that this year due to strong export sales. We've seen corn prices come up a little bit, but it could end up also causing deeper depressions in our fall harvest prices due to having not just our supply but Brazil's supply end up hitting at that time. For those that aren't familiar with Brazilian agriculture, what they'll typically do is they'll plant soybeans now in our fall, harvest them in January, February, and March, and then follow it by corn, and then harvest that corn off in June and August. So if you look at the prices where we've been, we're virtually the same as where we were a year ago, right around that $4 mark on the December contract. We have seen a substantial price appreciation, about 25 cents. There's a few reasons for that. We've seen some increased prices due to some weather concerns down in South America. And then again, I mentioned we've had strong corn export sales, and that's increased these prices up to where we're just over $4 on the December contract. Again, I've been saying this all through the winter, looking at right around that $3.90 to $4. That's a good place to end up starting to look at pricing some 2018 production on the futures market, and then look for your basis opportunities depending on where you are located throughout the state. We switch it over to soybeans. Soybeans, this is again where they've got their initial estimates for 2018 crop year. The same amount of acres planted as corn at 90 million acres. Average yield of 48.5. Again, that's going to depend on how the growing season progresses. The big change is there's a beginning stocks increase of about 220 million bushels up to 530. I could see that whittling down if we get strong exports. I'm sure most people have heard a little bit about the drought going on down in Argentina and some of the wet weather concerns during harvest for Brazil. Obviously, if their production is reduced, there's a chance for us to export more and end up knocking this number down a little bit. The good news is, as it has been for the last several years in soybeans, is that demand remains exceptionally strong, and that's really helped keep our prices above where corn and particularly wheat have ended up going. Both our crush and exports are estimated up, combined about almost 250 million bushels, and then our ending stocks are estimated down. We do have large foreign stocks, which is a bit of a concern. However, given the issues that are going on down in South America, I would anticipate that those foreign stocks would potentially come down a little bit, because we do have the two big producers in South America, Brazil and Argentina. So between those two and the U.S., we're talking about roughly 80% of the global production. So that's why it's so important what happens down in South America to what's going to happen with global stocks. You can see the U.S. estimated price. This is farm gate price of $9.25, down 5 cents from this past year. Again, I wouldn't be surprised if this was revised a little bit given some of the concerns in the price rally we've seen in soybeans. This is a big one. I've showed this one several times throughout this winter, updating this as the marketing year continues to progress. We still have not been able to close this export gap between what is projected, which is 2.1 billion bushels, and what we've actually shipped, and then what we've got out in outstanding sales. To me, this is really important to end up closing this gap, because if we don't end up starting getting more exports, we'll end up producing and have a larger carryover for the 2018 year. Now, obviously, with the concerns in Argentina, the potential exists to close this gap very quick. It's a little bit surprising that it hasn't, given what we speculate is happening down in South America. We still haven't been able to close this gap. Now, that could end up materializing in the next few months, but if we don't end up having this gap substantially closed by May, that's going to be problematic. You look at prices, November soybeans, this is November 2018 soybeans. We've been trading about 125 cent range over the last year, but you can see that tremendous 75-cent increase over the last 2 months. And again, a lot of this is going to be attributed to two factors: the drought in Argentina, and then again, there's going to be a big chunk of speculative money that's flown into the soybean complex. One thing that I always caution about is when you have investment money flowing in, It can flow in really fast and result in a price rally. It can flow out just as fast and result in a price decline. So again, we have to be very cognizant of underlying fundamentals changed, or is this going to be similar to what happened in wheat last summer, where we got the run up as a result to the drought, but when we exited that price peak, we actually came out at a lower price than what we went into that rally in. So again, you know, I'm not saying that prices can't go higher. They absolutely can. We have fantastic demand, and supplies appear to be constricted a little bit down south. I'd just be a little bit concerned given our reliance on exports and some of the saber rattling on international trade right now. To me, it makes a lot of sense to look at getting a price established when we're up above this $10 range. So again, this is just kind of a summary of what I ended up talking about. One that I'm watching, I think soybean acres, particularly with this past rally, I think the USDA's got it probably a little bit low. I could see another 500,000 acres to 1 million acres planted. I think that's going to be important as we move through this planting season. The other one, for those out in West Tennessee, that's been closely followed, is the rise in cotton prices. I'm not sure how much acreage we'll see an increase in, but I definitely think that, you know, we'll probably see 150 to 200,000 acres up from last year, just based on the price rally that we've seen and the fact that we've got harvest futures prices above 77 cents now. I think that is attractive for those that are interested in cotton. So now I want to just kind of switch it over a little bit and talk quickly about crop insurance. For those, I'll just give kind of a quick overview for those that maybe aren't as familiar with crop insurance. It is a tool to help manage production, financial, and/or marketing risk. There's two basic types of crop insurance: yield versus revenue. Yield, you're looking at a yield guarantee. Revenue, you're looking at a revenue guarantee. So again, when you're talking yield, you're talking bushels per acre or pounds per acre. When you're talking revenue, you're talking dollars per acre, which is a combination of yield and price. APH is the yield that you are able to insure. It's usually based on your 4 to 10 year average for that crop, for that farm, or for that unit, insurable unit. So again, APH is really key. You want that number higher, as high as possible, because that's going to give you your highest guarantee as you move into purchasing the products. Other important considerations: unit structure. There's kind of 3 different basic units. You have whole farm, you have enterprise units, and then you have basic or optional units. They're subsidized at different levels, and they provide different levels of production, or protection. So it's really important to end up looking at unit structure. Buy-up level, more people are probably familiar with that. Typically, you can buy up from anywhere 55 up to 85% of your estimated revenue. Obviously, as you increase your buy-up level, you will also increase your premium cost. Mentioned yield versus revenue. You can insure based on production practice. Probably the most applicable one would be irrigated versus non-irrigated, but you also have organic versus non-organic that you can end up insuring. Yield exclusion, that's an important tool that you can use to increase your APH. What that allows you to do is allows to exclude yields where you've had yields below 50% of the county average from your APH calculation. Trend adjustments is another important tool that can help improve your APH. And then the last one is premium cost. We always want to be cognizant of how much we're paying in premiums. So again, just to kind of highlight on the premium cost, there's 2 components to it. There's a government cost share, and then there's a producer paid. What that ends up giving you is a total premium, and that premium is supposed to be actuarially sound. And what that means is it means that over the long term, so if you look at a 20-year time horizon, you're taking in the total premium roughly as much as what you're paying out in indemnities over the long term. I mentioned the subsidy levels. You can see the buy-up coverage on the far left axis, ranging from 50 up to 85 for traditional crop insurance products, and then there's some area protection ones I'm not going to talk about today, but they have different subsidy levels. The big difference is typically evaluating between enterprise and basic or optional. Basic and optional is going to give you more farm-specific coverage, whereas enterprise is going to kind of pool some of your farms together. So you have to really evaluate which of these is going to make the most sense based on the number of farms you want to end up insuring and what the risk profile for each one of those farms is. You look at key dates for crop insurance, sales closing date, we have that creeping up in 8 days from now. So March 15th is when we have to have our sales closing date for corn, soybeans, and cotton. For wheat, it's September 30th. And then you have your planting and your reporting days, and then your premium billing is August for our 3 spring crops. Why is it important? Well, if you look at Tennessee for last year, 82%, somewhere between 80 to 88% of our planted acreage was insured through federal crop insurance. So again, it's an important risk management tool, and one that you really want to evaluate on an annual basis to make sure that you're getting the most out of the product as possible. Each year, the prices are determined for the spring crop insurance price. So you can see for these 4 commodities, corn, cotton, soybeans, and sorghum, the price discovery period is February 1st to February 28th. And what they do is they take a rolling average based on the harvest contract. So December for corn, December for cotton, and November for soybeans. Take an average over that 1 month period, and that's what your spring price is. Your volatility is a little bit more complicated. I'm not going into the details on how that's calculated, but what it is used for is it's used to determine what your premium costs are going to end up being. If your premium costs, if your volatility is higher, your premium costs are going to be higher. If your volatility is lower, your premium costs are going to be lower. So again, why is crop insurance important? These are Tennessee specific yields for corn in blue and soybeans in orange, along with the trend line yield. You can see these massive deviations from the trend line yield back in 1980. More recently, we had in 2007, let me just go back, 2007 and then 2012 for corn. So when we're looking at these, what we're really looking at to protect against is some of these deep losses, deep in-season losses in yield reduction. Obviously, if you're buying revenue protection, you cover some of the price as well, which is also important. But I mean, these deep yield losses that we have ended up seeing in 2007, 2012 in particular, is one of the ones that really necessitates looking at these crop insurance products as a way to secure a amount of revenue. So how's crop insurance performed over time? Well, if we look from 2007 to 2017, this is for each producer paid premium dollar. So I'm not counting the government share of the premium. If you look at for corn, for every dollar that a producer has spent, there's been $2.65 paid out for corn, $1.40 paid out for soybean, $1.84 paid out for cotton and wheat. So we're putting in $1 and we're getting out more than $1. It's a net benefit. Now you can see over the last 3 years, we've had wheat pay out a little bit, cotton pay out, but corn and soybeans really haven't paid out in terms of providing more than what the producers have put in. Where you get that big benefit is when years like 2012 or 2007 end up occurring. So again, it's one of those ones where this is a pretty solid product in terms of looking at securing a minimum amount and getting a decent return based on the investment or the cost that you put into the product. This one I just spend a little quick time on. This is for corn in Tennessee. Most people, you can see there's about 4,600 policies for revenue protection that are being purchased in the state. That's covering about 586,000 acres on average. You can see it's well over 75% of the producers are purchasing revenue protection insurance. The other ones that are there are yield protection and CAT, and then there's the area protection plans. Really not a big adoption of SCO or revenue protection with the harvest price exclusion, but they are available. In terms of buy-up coverage for corn, typically what we've seen over the last 3 years is most producers are buying up somewhere between 70 to 80%, with 75% being the most common for revenue protection. For yield, you can see the number of policies is 10 times lower than what the revenue is. But again, you're looking at a little bit smaller buy-up in terms of yield protection. You look at soybeans, very similar picture. You end up getting, about 4,700 policies sold for soybeans, covering 1.1 million acres. For some reason, those other two graphs aren't showing up on this side, but they are virtually identical in the fact that they're buying about 75% on the buyout. So marketing and crop insurance. One that I always say is very important to evaluate is what that APH is. It is very important to look at each insurable unit to determine what that APH is versus what the expected or trend yield is, because there can be some large discrepancies there. APH, given how it's calculated, that 4 to 10 year average for that insurable unit is almost always lower than expected yield. So for a quick example, if you have an APH on a farm, we'll say that you're insuring as a non-enterprise unit. If you have 130 bushel per acre APH, but you're expecting 180 bushels per acre in production, if you buy that revenue guarantee, you get 130 times the spring price times 75% buyout. What you're getting is a revenue guarantee of 386. What your actual expected revenue is that 180 times what the current price is, 396. So you're getting $713. So you're buying 75% coverage, but what you're actually getting is about 54% coverage. And that just highlights the importance of why that APH, you really need to look at how it differs from what your expected yield. And you can do the same thing for soybeans. I'm using corn in this example, but evaluating how that APH differs is really going to determine the effectiveness of your crop insurance product, and look for potentially having to augment it with some other marketing strategies, whether you're looking at an options or future strategy, or even looking at forward contracting. Some is another way that you can end up getting some additional coverage. This one right here just kind of highlights how much revenue your insurance is covering versus what you're anticipating from the crop. So essentially, I took a spring price 396 this year, the APH of 150, buy-up of 75%. So your crop insurance guarantee is 445. So if you end up having 110 bushel on 350, you will actually end up having less revenue than 445. If you have 150 bushel expected production and $4, you'd have $154 worth of revenue that's not protected by crop insurance. So again, that might trigger the potential to end up increasing your pricing. Another way to look at this is we have the revenue guarantee at 75%, using that same 150 bushel APH. If you have an estimated production of 150 bushels per acre for these different prices from 350 to 450, if your expected production is 150, you're really not getting much coverage unless you're going to see a yield or a price decline below where this graph ends up indicating it, right? The only one where you'd actually get some coverage is if your estimated yield was 110. So again, what you really want to look at here is if the revenue is anticipated to be above the crop insurance guarantee, you might need to employ additional marketing strategy or securing additional price and revenue on some of that production, just so that you're managing your risk. The other one that's really important to account for when you're looking crop insurance and marketing strategies is we have several parts of the state where we get a very strong basis. We get local prices, and that's how we market our crop. But when you're looking at crop insurance is based on the futures market, so a quasi-national price. So one thing that we don't want to forego is the advantage that we have in securing a higher basis. So again, just because we have a crop insurance policy doesn't necessarily mean that we shouldn't be looking at other ways to secure price. One of the ones that always works well, if you're looking at securing a beneficial price in terms of cash markets, you can look at cash forward contracts, or basis contracts is another one that I think we can utilize, particularly in that lower middle part of the state. But in general, I think those are sound strategies that can be used in conjunction with crop insurance. Just to kind of summarize, I think crop insurance it's an essential risk management tool. I think it's deemed as a base to build a marketing program on top of. I think it provides a minimum level of protection, but you really want to look how it can end up working with your contracts, so your cash forward contracts, your basis contracts. If you do want to look at options or futures, I mean, you can work with a broker or develop a strategy that is effective in using your crop insurance as a base, but also augmenting that in order to secure potentially higher prices or more revenue through some of these additional products. One other one that I think is really important is you really need to evaluate each insurable unit. There are times when enterprise units make a lot of sense. There are times when they're really not going to give you the protection that you end up needing, and you might want to look at optional or basic units that are higher premium but are going to give you more coverage. So again, I think that's really important to look at that. And then, as always, working with a qualified insurance representative. We have some really good ones across the state. I think that a good insurance representative is worth their weight in gold to a row crop producer. It's something where they can save you a lot of time and help you end up protecting against a dramatic decrease in revenue for your farm. So using this network is I think essential in order to make some of the decisions to mitigate these risks. The other one that I always say is, bankers will really love crop insurance products. So having your crop insurance agent work with your lending institution can be a real benefit in trying to secure that operating line of credit in order to end up going and planting those crops. So again, I think that's really important to work within the network that you've surrounded yourself with in terms of being able to get the best product that's going to meet your needs.